Well, good afternoon, everybody. My name is Lee Schwartz, and I'm the Director of Business Development for SVA Certified Public Accountants. I'd like to welcome you to part 3 and the final webinar in our Economic Impact webinar series. Today's topic is why valuations are an important tool now. But before we get started, I just want to take a sec and say a few words about SVA. Our vision is to remain independent, and our goal is to continue serving the same clients we have since 1974. And that's closely held businesses, family-owned businesses, nonprofits, and high net worth individuals. And our mindset over these last now almost 50 years is that when you're a business owner or shareholder, that business is more than just a job. It's going to affect you personally. So it's important that your advisors are not just about compliance, but that they're working collaboratively with you in a consultative way. And that's our goal. This webinar and others like it are just one small way in which we do that. As far as this webinar goes, please send in any questions you may have as we go, but we'll wait until the end to answer them. Now, if you're a client and your question doesn't get answered, we'd encourage you to reach out to your SVA contact. If you're not a client and you have questions, please reach out to me and I'll make sure one of our subject matter experts gets that question answered. So let me briefly introduce our speakers. Brian Thiel is a senior manager and a certified public accountant, and Dan Glomsky is a principal and is accredited in business valuation and is a certified valuation analyst, in addition to many other letters behind his name. Overachiever. So without further ado, Dan, you ready to go?
I think I am. Thanks, Lee, for the introduction. And I'll see if I can add some more letters to the name over time here. So thank you, everybody, for attending this webinar. I hope to share with you some information that'll be useful for your business, and then also maybe succession planning or thoughts as far as where to take certain things. The objective of this webinar is really kind of 3 items. It's like when and why evaluation is important. So we're going to go through some stories that we might have experienced that will hopefully illustrate that. We want to touch upon the impact of the pandemic on the valuation numbers and somewhat of a economic impact as well. So it's a big component. We definitely want to make sure that everybody understands kind of the landscape and how it's been forming out there. And then the third one is really just to kind of bring everything full circle and say, talk through the benefits of having the valuation for gifting strategies. I know we're mentioning gifting, but there's other, we'll call more succession strategies, whether it's a sale, a gift, transition to family members, all those types of things. So we want to hit upon those 3 things. So if I do all those items, I think you'll get a lot out of this webinar and be able to take something back. And certainly if you have questions, you can always reach us afterwards, as Lee will attest to later on. So with that, let's get started. And we'll go with a polling question, just kind of engage everybody, make sure everybody's still awake. I know it's early on here. So what is your primary reason for being interested in evaluation? So I'll let you read through the 3 choices, but it's looking to sell a business, looking to acquire a business soon, partner, shareholder, or potentially joining or leaving the business, exploring gift strategies, or just curious what my business is worth. So if you could make that submission and send it back to us, and we'll give you the results. Once we have the information, we'll post that there. Okay, so it looks like potentially people potentially joining or leaving the business. We also have looking to sell soon. And I think the looking to sell soon is definitely a strategy that is worth paying attention to and knowing what to do in that process. So to start this webinar, what I want to do is I want to start with the kind of some fundamentals of the valuation world and just give you a little bit of background as far as what kind of goes on in evaluation, so that maybe a reveal behind the curtain, and some of it you may know, and some of it may be things that you thought you knew, but weren't sure about, or things that's like, oh, that's just a rumor and that's actually not factual. So I want to kind of sort through that type of information and see what we can do to kind of square everybody off. A valuation approach or valuation analysis includes us looking at the three primary approaches to evaluation. And the reason that is important is because when we're looking at data, as exciting as it is, right, we want to try to get data points to line up, and that gives us validity with respect to the number. And also, these are things that potential buyers would look at. Could be what IRS agents look at, a variety of things. So we want to try to get to these three approaches and try to put some kind of number to them, and see how we're doing from a verification perspective. The first approach is what I would refer to as a net asset approach. And I say including goodwill, because what we basically do is we look at your assets held by the business and we try to value each one the best we can. And, we got to be sensitive to how much it might cost to particularly go and appraise particular assets. So if you got a bunch of equipment, we might say, let's take the original cost and reduce it some percentage for wear and tear or use or age and that type of thing. So we'll come up with methodologies to try to value that equipment as its fair market value, but it might not be exactly precise. But there are equipment appraisals out there that we can go get and have people engaged to do that type of work. If the business owns real estate, we'll generally speaking have that real estate appraised, but we can use real estate tax bills and other things to try putting some kind of number to it. But we'll look at the assets and we'll try to come up with how much each asset's worth from a value perspective. And then we also want to add that element of goodwill, because we can have our physical assets, our cash, our receivables, our inventory, our equipment, our real estate, and we can subtract off our liabilities, our notes and payables and stuff like that. And that gives us to our net equity position, which is really what we're trying to value. The problem is if you have a company that's profitable and has intellectual property and so forth, there's a goodwill component. There's this blue sky that they reference it to. And that we don't want to lose track of that, because that's, quite honestly, that's where a lot of the value is in these organizations. And depending upon the type of business you're in, it could be a substantial number. So the net asset approach includes those assets. It also includes that goodwill we'll call blue sky. The other approach is an income approach. And the income approach is really us trying to determine how much cash flow a business generates, and then apply a cap rate to it. And that tells us how much an investor is willing to pay to get that type of return from the business. With that, there's assumptions as part of the income approach that you have to be mindful of. And that is that the number that we come up with as part of that income approach or that analysis, we would potentially subtract off how much debt the company owes from a notes and that type of thing. But we will also make the assumption that the fixed assets and the working capital, which is your inventory, accounts receivable, are all contained inside that business and are part of that income approach value. So sometimes you'll hear people say, oh, I get to take my cash flow and I get to capitalize it. Then I'm going to add my accounts receivable, my inventory. And it's like, it's not necessarily how it works. So we want to be careful from that perspective. And then the third approach is what I would refer to as the market approach. And this is what I would say most people are familiar with as far as when they hear somebody reference, oh, I got 2 times revenue, or I got 5 times EBITDA, or I got 6 times seller discretionary earnings, that type of thing. Those are all in most cases what I would refer to as market references. We might come up with those multiples as a result of using the income approach or the asset approach, but the market approach is really us looking at transactions that have happened in the marketplace that we can then say, okay, well, that industry, that business sold for X times earnings, X times sales. And we look at the various variables within those items, because there's certain multiples that I would say are stronger indication of value than others. So if I have a business that is a manufacturer, and it really has a lot of substance to its processes. If I were to just say, here's my revenue, well, that might not be indicative of what the business could do, because I could have a lot of expenses that make the bottom line not as profitable, or it might be on the other side where I have a very efficient business and it's kicking off far more profits than its peers. Then when I'm using the income approach or using a revenue multiple, that can be misleading. So the reality of it is, research for market data. We'll also look at publicly traded stocks to see what kind of multiples they might be trading at. That requires a lot more work and digesting of data, and would only really be relevant if I can find a match that I think, okay, your business completely rides along with that, various stock, right? So if you're, I'm not comparing you to Apple unless you're, building, phones and laptops and iPads and that type of stuff, right? So I'm looking for kind of similar industries. So those are the three approaches, and we look for the, data points to pull them all together from verification perspective. And then as part of that process, it's important to look at the historical results. And normally we look at 5 years of financial data to try looking at the business trends, the ups and downs and so forth. And one thing we'll get into later on is the pandemic, right? Because if we look at 5 years, we got a COVID period, we got a catch-up period, and we got, things maybe coming to some normalization, but then also we have the supply chain issue. So although we look at 5 years, that 5 years may not necessarily be representative of the future. And the reason I say that is because a valuation is really a forward-looking value for your business. It's not what that business has done historically, it's what that business is going to do in the future. That is what we're trying to value. Now, we use historical data to try to get there, but the reality of it is we're trying to get forward-looking. And as part of that, we want to try to understand your business as the best we can. And then we want to also compare your performance of your business to your peers. And we have, industry data out there that we can pull. Now, the reality of it is you got to take the data with a grain of salt, understanding that it may not be apples to apples, right? We may have an apple and a few oranges mixed in with that analysis. And we got to try to weed those two out or use some reasonable basis to try to draw those comparisons. So from there, we go into, basically understanding the business. And I think Brian's going to give us a few thoughts on what that is and then what data we might look at. So with that, I'll introduce Brian to this process.
Thank you, Dan. Yes, some of the most important elements of understanding a business company are listed on this sheet, but what I'll do is go through some of the different items and then kind of the documentation that we would ask for to help support those things, because we really need to understand what your company is, and then from there we can kind of compare it to other things. So the first item, revenue growth. Some of the items that we need for revenue growth is, as Dan was talking about, the past 5 years of financial statements. We'd also need the most recent 12 months of financial statements, any projections or forecasts that you have, and then, kind of a customer list of your 5 largest customers. These documents help us understand what your historical growth has been, what you think your future growth is, so that'll give us the idea of, okay, how is your growth plan looking like? And then we can look at some industry data to see kind of what some analysts think the industry are looking at. The next item, profits of the company, net or gross and net. Some of these financial statements help us understand that, which then gives us the thoughts into kind of your cash flow and things of those items. Services and products, part of the reason that we kind of looking for top 5 customers and other documentations in regards to your services and products to figure out, okay, within industries, there are, for argument's sake, industries. So it's understanding those different services and products, what the margins are on those. And as we look at this, these are things that we can help advise on if you compare correctly to the industry, or are there things that you can do to change to increase the value of your business.
And Brian, and one thing Yeah, Brian,
ahead,
one thing I would add on the service and products, right, is we're really trying to identify whether you got, you have a product at the end of its life, right? Do you have a product that's, being rejuvenated and pushed back out there? So, because we're looking at, okay, we might look at trends of products, right? That product might be tapering off from a growth perspective, but another product might be surpassing that. So we're looking for those types of events.
Thank you, Dan. Yeah, no, to add on to that, I guess, has your company changed? Are you getting into new products in the industry? To try to understand those too. Those are all effect items. Compensation of owners. A lot of people think compensation of owners is just your annual compensation. That's not the case. Your compensation is your annual compensation or your annual pay. What's your life insurance premiums, disability insurance premiums, country club premiums, auto expenses, other items that are paid for that are benefits to you as an owner. Those are all considered compensation. So it's understanding total compensation, and then looking at that compared to what the industry is to see if compensation is high or low, because those will be other factors that will help us understand and or adjust for to calculate the value of your business. Understanding the number of employees you have and what they do. So kind of a chart of accounts or a chart of who is employed by you, what's your management, who are the employees, what do they do? Those are all types of things that help us understand, do you have, the right amount of people, or the people in the right places? Those will help us consult and or advise as we go through the process of valuing your company. Equipment
And Brian,
used, so
to that point too, right? The number of employees is an extremely important thing right now, because there's labor shortages and that type of thing. So I'm right now going through a transaction with a client that's looking to sell their business, and we're working with the buyer, and they want to know that employee list. They want to know that they can handle some increased capacity and so forth. So these are the things we're trying to drive through, but also feedback we're giving back to the client as far as, do you have the capacity for growth? Does a buyer see that as attractive or not? Same thing with owner's compensation. So some people will take and they won't run much compensation through for an owner. And then what they'll do is have a better bottom line. And then they want to sell that better bottom line. But yet when a buyer comes in, they want to continue to work. And then all of a sudden there's a price adjustment as a result of that. So we're trying to variably factor those things in.
thank you. And then equipment, we'd ask for a list of equipment, so your depreciation schedule, so that we can kind of see how old your equipment is, what's the values to the equipment. And then, we potentially have a list of questions related to, do you expect any equipment to be purchased in the near future? Are there obsolete equipment that you don't use? So that kind of leads into, is there space that could be used for equipment to help you expand if you have the employees to do so? But then, it also helps in the part of figuring out in the future how much equipment is going to be needed, which, any prospective buyer or others would be looking for to help them understand how much their cost would be. Rent, there's, related party rent, there's or third party rent. And what that would be looking for the leases, because part of it is trying to understand, okay, is the rent for market value rent? Or is it something that in most related party rent, it's the rent will fluctuate based off on how the business is doing, or where you want the money to flow, or what's the best tax perspective of different pieces of it. So those are things that if rent is too high or too low, as Dan will talk about in a later slide, there might be adjustments for that. Sales and cost of sales. So some things with that would be wanting to know who your top 5 vendors are, and do you have any contracts with these vendors that you can get certain terms to help keep your costs down, and currently with everything that's going on, costs are going up. So it's understanding what your gross margins are, and we'll kind of look at that and compare you to the industry and what's the margins in the industry. So are there, other suppliers out there that you could potentially utilize to increase your margins to be more industry comparable, which also then will increase your bottom line and also increase the value of your business. And there's many other items and many other things that we ask for, but we just kind of wanted to correlate some of the list of items that we ask for and how those relate to different areas that we look into that are important to valuing a company. But as I said, there's much more, and not to bore anybody with more details, I'll pass it back to you, Dan.
All right, perfect. So yeah, to Brian's point, when we do a valuation, we'll send a client a list of, let's say 30 different items that we want to try to collect from them. Now, some of those things are things we can maybe get by with, depending upon the level of analysis that we're working on. But the reality of it is we want to get enough information to basically understand your business, understand who your competitors are, understand who your suppliers are, understand how strong those relationships are, understand how your employees are operating, understanding your cost models. We're looking at all those things because that's what a buyer is going to look at, right? And a buyer is going to, pick holes at any one of those things. And if we can kind of prepare to plug those holes or be able to explain why they exist, we put our clients in a far better position to get a better price for their business because they don't get walked back on a purchase price because it's a solid business. So that's what we're really trying to do when we go through some of these things. So with that, let's go to some normalization adjustments. And the reason that the normalization adjustments are important, whether you're doing a business transaction or whether you're transferring it to a family member, is that the last thing we want to do is to say, okay, the value is worth X, and maybe the family member is going to buy it from another family member. So they're going to need cash flow. And if we say, okay, here's the cash flow that we use to value the business, and then later on, all of a sudden somebody's taking more compensation, or there's an increase in rent, or whatever the case might be, all of a sudden that cash flow is gone. And that's a big surprise that we totally want to avoid. And as part of our valuation analysis, remember, we're forward looking on that valuation. So if we have adjustments that are going to be paid in the future, we want to make sure that we grab those adjustments and have built them into the valuation model. So the compensation is one I kind of briefly touched upon, the fact that some people don't pay themselves enough compensation, and then all of a sudden they're out of the transaction, and now their compensation is higher. All of a sudden that cash flow available is less or gone. So that's a big thing. Then the other thing is sometimes people pay themselves too much compensation. I could pay a family member, I could do all kinds of things, and the compensation really, in essence, goes away once the transaction occurs, whether it's a sale or succession onto another family member. Well, those things impact the financial performance of the company, cash flow, value, right? Same thing with rent. There's situations where somebody might be charging a large amount of rent, and all of a sudden the value is being dropped down. So they pay a lot of rent, makes their profits less. And when I capitalize that cash flow that's smaller, I get a lower value. And then all of a sudden now we're outside the transaction, and the amount of rent I'm now only getting, a third of what I was getting before. Well, all of a sudden that business became more profitable. Then we get to the point of saying, okay, I got more profit, I should have more value. And, then it's a different result. So we need to make sure we understand these things. We also look for one-time expenses or adjustments, right? Somebody might have put in a new computer system, had a bunch of conversion consulting time, and all those things are built in professional services. So our professional services are $50,000 higher than they normally would be. Well, if I value the business with that $50,000 of expense into it, I have a lower income, I have a lower value. I've incorrectly valued the business, because now going forward, that won't happen again for the next 15 or 20 years, or however long somebody takes to implement a new accounting system or computer system. So these are the things that we're looking for and we want to adjust for. And there's other things. There's things that come up with respect to margin. Somebody might write off an inventory. Somebody might have a bad job. There's a variety of things that we can run into. We'll ask the question, but also we'll look at the financial statements and try to identify things that have happened. And certainly one thing that has happened is the pandemic and the COVID and a lot of things from that perspective. So we've been trying to adjust for those types of events. So one thing I want to now touch on is the good old rule of thumb versus the valuation analysis. And here, I can't tell you how many times a day somebody comes to my office and says, hey, what's the multiple for this industry, and so forth. And you give them a number and they're off, right? And it's like, I just don't know if I sold the business for a lot of money or not, right? So we got to be careful on what that rule of thumb really means. So to share that with you, so rule of thumb has some credibility or substance to it, but there's a lot more to it, as I just explained in all the prior slides. Is you have to understand that business. You have to understand how strong that revenue is, how strong the profitability of the company is, whether that, rule of thumb multiple that you just received is applicable to your company and what kind of translation it gives you. And then the rule of thumb is only one data point. So when I just said, remember, we have 3 approaches and we're looking to try to line some data points. I just have one, and then the straight line down one data point is always going to be straight and has no validity to it because I didn't check it. But rule of thumb is basically based on business transactions that have happened over time. It's captured by industry code. We do have those. We will look at those, but again, with a grain of salt, right? It's like it throws me into the ballpark. It doesn't mean that my value could be $1 million higher or $1 million lower, or some bigger swing than that. But
and with that, it's your business is unique. It's not necessarily an average of an industry or something of the industry. It's unique. There could be more value to it based off of specifically what you're doing versus what others are doing.
And that's a great point, right? I mean, and I can't tell you, I can look at, one heating and cooling business and another heating and cooling business, and they could have similar revenue dollars, but the profitability is completely different. Or they have one has more employees and one has less employees and stuff like that. There's all these different variables that change, and the ability to grow a business is something we need to look at and think through. So when we do a valuation analysis, we have that market data and we have that rule of thumb in our analysis from a review perspective, but it's not what we're making our decision based on. We're actually getting to the fundamentals of a business valuation and applying what, like Brian said, the uniqueness of your business into what that translates to value. So with that, let's go to the COVID, inflation, supply chain, and how they've impacted the value. So this has really created an issue for the valuation world, because a good portion of it is looking at that historical data and saying, okay, this historical data is now going to repeat itself in the future. And there was some businesses that did phenomenal in 2020 and 2021, right? But now we're seeing in 2022, we're seeing some drop off in it. But we also have businesses that really struggled in 2020, but then just surpassed everything in 2021. So we almost see it like a catch-up period. 2021 is maybe an average of 2020 and 2021 together, maybe gets you close. But the reality of it is, in 2021, if I was able to do all the things I didn't do in 2020, then that maybe thinks that this business could be pushed a little bit harder and further. But then again, we need the customers and everything else to follow along with that. So when we look at the historical data, a lot of the transactions that have been part of, we've kind of blocked out and said 2020, whether it was good or bad, we've kind of chopped it off and said it's just got too much noise in it, and we can't rely on it being an indicator of the future. And then we'll do some calibrations to 2021, maybe to get it to what we believe is more normal. And we'll use the 19 and 18 and 17 data to sometimes try to validate what that might look like. So that's one thing that we got to be careful on an evaluation. And again, sometimes we see the rule of thumb being applied to the average 3 years of earnings or something like that. Well, if I got a COVID or I got a post-COVID result coming out of there, I got to be careful on what I'm doing there. Inflation's also hitting us. So inflation is causing the price increases to go up. We're seeing that all of a sudden the profitability of these businesses is temporarily going away until they can get the price increases or the revenue increases get through. Sometimes clients or businesses are not raising the revenue equal to the amount of inflation they're experiencing from a cost perspective, because maybe they feel like they can't. So I've had several discussions with clients that I'm doing business valuations on, saying, hey, you're not increasing your prices enough to match the inflation. Why not? What's the plan? And they just feel like they can't. And I kind of show them hey, that other businesses are doing this. You have to, it doesn't pay to operate at a loss or less profitability if you're incurring those costs. So you got to find a way to manage that, and that impacts it. So it really affects the results. Again, it affects the value. From a change in interest rates, we're looking at what that means to, when I say I take that cash flow and then I apply a cap rate to it. Well, that cap rate is a byproduct of basically what an investor expects to receive. And when we look at that, we look at what an investor, they can take their money and they can invest it in your business, or they can take the money and invest it in the bank, collect interest and stuff like that. So as interest rates go up, the competition for that, investment opportunity starts to become more competitive. So all of a sudden there's less interest in putting more money at risk in your business, and they might want to just go buy bonds or something like that and utilize the interest rate. So when we see this, we see it as a reduction in values. It's creating some adjustments. Now, with that being said, right, a business itself could be more valuable today than it was before the interest rate increases, purely because of the type of business it is. So we can't just say, oh, interest rates are up, values are down. That's not an appropriate answer. So there could be some value reductions, but there might also be, hey, my industry's hot, and therefore the values have gone up in that industry. So when we say change in interest rates, you got to understand, yes, it brings values down in theory, because the cost of that interest is, again, affecting things, but know that it's not a blanket statement. Then the third component we're really running into is supply chain, freight price, cost of products and labor. And the reality of it is we're trying to predict that future. And we're having clients that will go and buy, a year's worth of inventory. I think Brian was talking to somebody yesterday where they said, yeah, we normally bought, 3 months of inventory. Now we're buying 1 year. And so there's a lot of that going on out there, which is also kind of, that company that sold a year's worth of inventory to somebody, right, just totally help their profitability and their revenue for that year, right? But now it could be next year that revenue is off, unless the new normal is going to be buying a year's worth of supply from now into the future. At some point, we're going to have some adjustment and some correction to that supply chain. So when we do, we got to be careful on that. So we always assess what somebody's inventory buying strategies are. Are they buying at the high? Are they buying at the low? That type of thing. So these are all things we look at from our perspective. Freight, the cost of freight. Again, we talk about a railroad strike or whatever it might be. All of a sudden, the cost to move these products and the time it takes to move these products has changed. So these are things that affect us forward looking, and it makes it somewhat difficult to really fix into what that cash flow might be. And then we see the labor, right? And I think there isn't a person I talk to or business I talk to that doesn't have a job posting or doesn't have the need to hire more people. They just can't have access to them. And so as a result of that, they're paying more in wages, but they're also running into, if I say a business is going to grow 3% every year into perpetuity, well, how are they going to do that if they can't add more people to do that? And so we got to be mindful of what that growth might look like and what the reality of the situation is. So we're kind of valuing a business with some of these variables factored in. All right, so let's try to bring it a little bit full circle here and give you some current trends within transactions. We're seeing a lot of corporate buyers come into the marketplace. And I would kind of categorize the corporate buyers as private equity groups that are accumulating businesses in a similar industry. And what they're doing is they continue to buy smaller businesses or medium-sized businesses, and they continue to try to increase that revenue, right? And when they increase that revenue, that increases the ability to generate more profitability. So when they try to repackage what they have, then the next PE group or a corporation that they sell to is willing to pay more because I have more revenue, I have more buying power, I have more opportunities to generate profitability than a company that might have been at 5 million, right? So now I take that $5 million company and I add it to a $50 million company. You know, I've just increased that opportunity for both the small company and the group as a whole. And then we have the private buyers, and the private buyers, we would say, are investors. And these are, there's less and less of these, in my opinion, because people are, it's hard to compete with the corporate buyer. Because the private buyer, generally speaking, I don't recommend them buying somebody unless they have the ability to cash flow them. And a corporate buyer has a lot more cash flow to it. Brian, I'm going to let you hit the next slide, if you can, and talk a little bit through about succession planning.
So succession planning, there's different thoughts of succession planning. There's different ways to go about it. And it's something I read a long time ago, is you should think about your exit plan as you start your business. And part of that is that knowing what you need to do throughout time to have the best plan, and not just waking up in the morning and going, oh, I'm going to sell my business. So, part of succession planning is that you kind of, 5 years or so before you're looking to sell, or at any point prior to that, but at minimum of 5 years is helpful, is that you're looking at what do I think I'm going to do with my business? Am I going to transition it to my kids? And maybe that's your plan. So you're, situating your business in a way that that's what you plan on doing. But the great thing about succession planning is that if you created something 1 year, doesn't mean that all of a sudden maybe your kids don't want to be involved in the business, so you can actually change it. And then you can, modify certain things as you go through time on what the proper thing is going to be. But it gives you an idea of what you need to do versus, just kind of, at the last minute, oh, this is what I'm going to do. And now I really can't plan to try to add the most value to my business, or, give my, children or heirs, something of value in certain things. Succession planning may be part of acquiring a business. That your growth is acquiring a business so that you stabilize things for your family, or that you will eventually sell a much bigger business that is more valuable than the small business that you might have started, which is, then your plan is to sell to either a strategic buyer or a private buyer. And there's different strategies and thought processes there. And then the other part would be gifting. What's the value of my business if I'm gifting it to my heirs, or if I'm, gifting it to employees. So what's the value to that, and how do I go about doing that? But, creating that succession plan gives you, different options, different ways of doing it. But knowing what your plan is, you can, do things to help facilitate that throughout time as you're working through your business. Not just a reaction that you wake up and I'm going to sell, or I'm going to do this.
Yeah, Brian, those are, that's exactly what, that's exactly what succession planning is. It's a sale, an acquisition, a gifting, right? But the reality of it is a business valuation in this process, right? If we're selling our business, we try to position the company better. And there's, in my opinion, and maybe I'm biased because I do valuations, is I get to understand the business the best I possibly can. I kind of know what your weaknesses are, and I kind of know where you can go in the future. So we'll have those types of discussions. If you're going to acquire, I might say, okay, I'll take a look at it, and we'll say, I'd only pay X for it. And you got to decide whether you want to pay more and risk something and what your cash flow might look at, but I spend a ton of time trying to evaluate transactions to decide whether it's appropriate for somebody to buy something, what kind of risks they're taking by doing so. And am I compromising my succession plan by making this acquisition? And obviously, a lot of these business owners are entrepreneurial in nature, so they want that, opportunity, and they do really well with them, right? So sometimes, it's kind of balancing what an entrepreneurial spirit will look like versus what the fundamentals of the numbers look like. And we have a very robust discussion on those particular topics and what somebody can do with a business. Gifting is an opportunity from a valuation perspective. If we can gift and do a valuation, a lot of times we can transfer some wealth to a family member and use up an individual's lifetime exemption, use less of it, right? And gives them opportunity to do other gifting and so forth. So there's a benefit in having a valuation done in a gifting model as well, because we have the ability to potentially gift more gifts away if we have an estate tax issue. So there's tons of benefits to having a valuation done. And, those are the things that, I guess I would say are benefits or uses of the valuation process. Another way I really like this is measuring your business. And, shareholders or board of directors of publicly traded companies really have a fiduciary responsibility to increase the value of the company for the shareholders, right? And that's at the publicly traded companies' expectation. Well, why shouldn't that expectation exist at the small, closely held family business level, right? So how do we determine how the company is doing? We can say, oh, revenue's up or this or that, but the reality is, where's its value? Are we creating a path of continuation? Are we creating an opportunity for us to sell to a strategic buyer in the future for a good sum of money? Are we, being innovative? Are we doing these things that add to the value beyond the financial performance of the company? So that's another thing I get big into as far as seeing the value of a valuation process and its uses. So with that, I think we have our final poll question, and then we'll go into questions, and you can send some over to us if you have them. So the final question we have is, having heard this presentation, what do you think is the best way to value your company? Just take an annual revenue and multiply it by 5. Compare your company to one that just sold and use the same number. Ask someone to make an offer. None of the above, your company is unique, and using a simplistic approach when purchasing or selling a potential lifelong asset is rife with risk and reaps of disaster. So make a submission. Let's hope everybody gets this one right, because it's pretty tricky.
It's going to take people a while. This is a tough one. Let's see how many troublemakers we have.
Yeah. It's always a couple in the bunch, right?
Yeah. All right. Well, there were at least a handful. Okay.
I will have to say, Lee, when I'm working with a client to sell their business, right, I never give them the purchase price. I never give them the purchase price. I say, make me an offer, right? And I know what I have in my mind for purchase price. So I get what they're saying there, maybe.
Fair enough. All right, guys, great information. We're coming close to the end of time here, but we did have a few questions come in. If anybody still has questions, chat them in. We did have some come in as we went. So let's get to it. So you guys talked a little bit about total owner comp and compensation adjustments, but somebody chatted in a question: is it better to stop running certain expenses through the business, or does it not matter?
I would say it doesn't matter if you can track them, right? I need to know that those are personal expenses. Now, with that being said, if I'm selling my business, I want to get that thing as clean as possible. I don't want to have to argue with somebody whether it was ordinary necessary business expense. So I would say, if it's my preference, I would stop running them through and start running the business pure as only business related activity.
Okay. So let's talk to, we had a couple questions come in about multiple valuations. So one person asked, how different could two different valuations be? Another person asked, how different might a valuation on behalf of the seller be from one on behalf of the buyer? So similar stuff there.
Yeah, I would say that, it goes to understanding your business, right? So how well did that valuator understand your business? And Brian and I were at an event yesterday where it was kind of a Shark Tank type of analysis, and they had 4 private equity firms bidding on the same business. Well, 3 of them were at like 37 million, one was at 50 million, and that included an earnout. So sometimes the details kind of create a false difference, but I think it's understanding the business and understanding what they're going to do with the business. So if I have a strategic buyer, if I have an investor, all these things can play into this. But yes, valuations can be different. And I do litigation for valuations. I have opposing counsel and myself, and we could be $1 million apart, but that's because we've either understood the business differently, have different visions of the business. So it's not necessarily precision, right? But we do our best to make sure, one, we value it appropriately, and that you could sell that business for what we valued it at.
So Dan, what would you recommend in the situation where, let's say, a seller already has a valuation and a buyer reaches out to you and says, hey, I have a valuation in hand, but I want a separate valuation. Like, how would you handle that?
Yeah, so the first thing I always like to do is take that valuation and see if I can see what assumptions they made and try to kind of assess the business based on those assumptions. I'm not interested in going and spending a lot of money trying to put a value on when maybe we can get there through that model. So I guess my objective is to see if it's workable. Now, sometimes the assumptions are so bad, or there's more information that really needs to be included that's not, or the method's wrong. There be things like that might say I need to do my own, right? But that's kind of how we go about it. And I have it a lot of times where I'm the seller and the buyer's giving me this blank times multiple, and it's like, okay, well, that's, give me your basis for that multiple. And it's a continuous argument from that perspective, but we work through it.
Yeah. Okay, great. Last question that came in. I think this will be a quick one, and then we'll wrap up. But what method of what method of valuation would you typically recommend for a services company with minimal physical assets?
Yeah, so we still want to know what that business is going to generate from a cash flow perspective, but each industry kind of has its own little model. Service, if it's a physician group, if it's a public accounting firm, all these different service models can have its own overhead and costs and so forth that we're trying to get at. But it's really, if that service is contingent on people, we got to be careful, right? And we got to be careful that we're going to have the people, that the people don't leave in this transaction, all kinds of things. So usually we look at like revenue multiples. I think those are probably a better indicator, but we also want to get more than one data point.
All right, guys, we're a couple minutes over, so I want to wrap up, be respectful of everybody's time. Brian and Dan, awesome information, lot to cover. There were a couple other questions that came in. Sorry to those of you who we didn't get to those, but we can reach out to you separately. And as we wrap up, I just want to point out, you can go to SVAaccountants.com to sign up for our tax alerts and our biz tips. And there's lots of other resources there to help you. And this is usually the part of the webinar where I mention the future webinars we have coming up, but we don't actually have any currently scheduled. But rest assured, if there are important tax changes or legislation that might affect you or your business, we'll pull something together. I just want to remind you all that the SVA team is only a phone call or an email away. So if you're a client, reach out to your SVA professional as questions arise. And if you're not currently an SVA client, you can contact me or anyone in our business development group so we can get you the help or the answers that you need. Thanks for attending today, and I hope you have a wonderful holiday season. Bye-bye.